Siddharth, the last 2-3 days move that we've seen, maybe the markets are waiting for Brexit, and that probably after that we'll also get, the reaction coming in, if any, to the change at RBI.
Good afternoon, Pankaj. Of course, market is waiting for Brexit. Globally, everybody is waiting for Brexit. But the kind of referendum, some kind of a voting pattern, if you call as, has been seen, is that they would be remaining with the European Union as it is seen. So if that is the case, I think it will really rejoice the market, and we can see higher levels in the Indian equities. Because there would be several of investors who would be waiting for this event and then take all of their investments. I believe that if the referendum is on the positive side, I think there would be a lot of fund flows into Indian as well as emerging equities.
Right, but markets are factoring in that there would be no Brexit.
Yes, somehow the way market is poised and the way it is in a range, I think it may not be going up, but it is not even coming down after such a big news coming of Raghuram Rajan not taking up the second term. Then also market behaved so maturely and was very much in a stable state. I think this gives an indication that Brexit also being into the European Union is more or less priced in.
Right. How would you look at the Mahanagar Gas IPO? Is it a good IPO? Are you giving a subscribe rating to it?
Well, we can expect some kind of listing gains in this company, because overall, if you look at the company, it has a monopoly in the Mumbai and other surrounding regions, Mumbai likes of Thane. And what we believe is the company balance sheet is strong. It's a near debt-free company. Along with that, return ratios are quite strong, around 20% it has posted for last 2-3 years. And on top of it, if you look at the future cash flows, I think 250 crores is expected for next 2 to 3 years. So FCA cash flows are also strong coming in. Along with that, valuations are quite attractive. If you compare it with Gujarat Gas and IGL again focuses into the Delhi state. But what we believe is, if you look at the valuations, yes, around 12 or 13 odd times which this company is trading at, I think comparatively the peers likes of Gujarat Gas and other companies are trading around 18 times and 45 times for Gujarat Gas. So that is quite steep. So comparatively it is quite attractive. So one can get a pop on the listing day. And if one wants to look for a long-term horizon, one can stay back. But I think there is little caveat. If Maharashtra government gives that kind of a kick which Delhi government has given in terms of banning diesel cars and focusing on more into CNG, I think then we can make a good value for a long-term perspective.
Right, but overall on a medium-term perspective, you think it's still looking nice whether that verdict comes or not, because it's attractively valued?
Yes, 13 odd times valuation, I think it is quite attractive comparatively to the peers, although there is not much of a growth in terms of profitability is concerned. So if you talk about last couple of years, despite there would be double-digit growth in terms of revenue, but looking at the margins, we cannot expect something big traction in the margins going forward. But looking at the aspects, financials and the balance sheet of the company, yes, with a medium-term perspective also it can be attractive looking at the valuations.
Siddharth, will this also add as a trigger for something like a IGL, maybe a GAIL, maybe some of the other players like Gujarat Gas, something that we saw in Interglobe Aviation?
Yes, there can be traction in these companies also, but looking at the valuation, I would like to again reiterate that these are all steep valuations. If you talk about IGL also, on the back of the Supreme Court verdict, I think it is quite good. So IGL, Gujarat Gas, these are all steep valuations, and along with that, what we would like to understand is if the crude oil prices, as it has rebounded from the bottom, if it is so, then I think there would be less of risk reward for these companies looking at the prices being rebounded.
Right. As far as something like the aviation pack is concerned, a lot of announcements coming in. Is that a reason to buy, or you think majority of the rally is behind and one should not try to chase these names because they are very volatile to macro environment, to what happens to dollar, to what happens to crude, as well as the overall global growth?
See, removal of the 520 rule and getting to a 020 rule, that was more of contemplated by the industry altogether. So that was also priced in. Altogether, what we believe is fall of crude oil prices is also there, which is one of the reason where all the stocks and the sector has gone up. In fact, the crude oil prices being rebounded to $14 and $50, I think that is not priced in into the stocks. I think that will come in if if this remains as a quarter average. Along with that, yes, the policy has been quite attractive, and it is more attractive and tilted towards the consumer. So there could be some kind of a dent, and there could be more competition for the incumbents, because the new player 520 rule getting scrapped. I think the newer players would be getting that opportunity in close by years to get into the international routes. So I think incumbents will be feeling the pressure on that front also. Although we don't cover any of the stocks in the sector, but what I believe is I think one should trade out the sector. If someone is getting good profits, I think one should book out also partially to be on a safer side.
As far as some of these names are concerned, on correction, they continue to be buy, as in, still the passenger traffic growth that we are getting, the news flow that we are getting, essentially it tells you that the industry momentum is on the positive side.
Yes, the kind of passenger growth and the kind of occupancy rate is going, that is on a positive side. On top of it, we have seen, if you compare it on a YOY basis, or if you compare it with 2 years basis, I think yes, for $110 crude coming down to $20, again rebounded around 70-80% to $50 odd. But still it is down from what we have seen 2 years back. So it is definitely positive. On top of it, the urban consumption is really improving. So on the back of that also, aviation space is really doing good. But with this, what we believe is one cannot stretch because valuation, because companies are doing good, but I think the prices have overstretched. So partial booking would be always recommended for the sector, which has really moved well.
So that, just a couple of names, something like a Hindalco, has clearly surprised the street by the 50-80% move that it has given from the lows. How would you look at it? Even now, do you think things are changing? They'll now be able to be in a better position to raise equity to, service their debt. Do you think you would buy Hindalco at these prices?
See, Hindalco is one of the stock in the non-ferrous space, in this metal space. Again, trading below its book value, so it was more of anticipated because most of the beaten down sectors had taken a revival. So this was one of the stock which went up. Along with that, what I believe is the kind of results the non-ferrous space across the globe is posting, giving an indication with Alcoa also, there was a little bit of a revival seen there also. With that, what we believe is in the TCRC margins also will improve for the company. So overall, in the overall space, what we believe is in the metal pack, non-ferrous looks quite attractive. Although we don't cover Hindalco, so it would be difficult to give an reco. But on a whole, it was quite beaten down, trading around below its book value, so it was more of anticipated, and there could be further stretches also because the pricing is very important, and little bit here and there because of the infrastructure public spending. I think there would be a little bit of a demand coming up also.
Right, but would you be a buyer at these prices, or you would wait and watch?
See, that is what I would not like to speculation in that, as if we would not able to recommend it, so because we don't cover the stock.
Right. Any view on Vedanta? That's also a name which has done very, very well.
Pankaj, in the metal space, we don't cover any of the stock. It's just because of being into the commodity space, and commodity space has its own cycle of many years. So, and altogether what we have is suppressed valuation and a suppressed stock as well as demand for so many years in the past. So we don't cover any of the stock in the metals pack. But still, I would like to reiterate with my view that non-ferrous space is one of the spaces which is relatively better than the steel space.
Right. As far as something like a Manappuram Finance is concerned, do you cover that? Are things changing over there?
See, we are quite constructive on the NBFC space, although Manappuram we don't talk, so would not like to comment on that. But if we talk about the NBFC space, if we talk about Max Finance and other stocks like Capital First, LIC Housing Finance, or Bajaj Finserv, we believe that this NBFC space has quite a good room to go up. They have quite a good penetration to go up. If we talk about precisely talking about Capital First, again deals in the main segments, that is SME, which contributes around 60% to the business. Then comes the two-wheeler space, which is 8-9%, and the consumer space, that is 10%. All these spaces are margin accretive. All these spaces are yielding better, getting better yields than a general wholesale lending books. So overall basis, what we believe is there could be quite good growth in terms of return ratios are concerned. ROEs are quite good. Balance sheet is quite improving. Even disbursal rates are improving. So looking at that NBFC space, and specifically Capital First, looks quite interesting.
Right. As far as Max you mentioned, after the deal, how would you like Max?
See, we believe that value is still there because more or less, if we talk about the merger which is happening, it is around 5,600 billion rupees is what the valuation of Max, and if we talk about 106 billion rupees is the valuation of HDFC Life. Looking at the merger and the synergies going forward, what we believe is definitely this is a welcome step, which we was the consolidation which the industry was speaking about 5 years back. I think it has started now. Max should be benefited out of this, even HDFC Life, because the cultures and the synergies should match up, and the margins and the product line is also improving after this merger. So we are quite constructive on Max Finance and overall space.
Right. And Max Finance, despite the recent run-up, despite the recent valuation, becomes one of the only insurance play, in the listed space. So, it would trade at a premium or a scarcity premium.
Yes, it would be a prime player, because after getting HDFC Life into the foray, I think it would be a prime player in the segment where it is. And what we believe is the valuation can be, because after the run-up which we have seen in the recent times, the valuation can be a little steep, but the earnings coming in, and I think the business improving, efficiency improving, as well as if you talk about the NIMs and other efficiencies and other ratios improving, I think Max would be given a better opportunity for investment with the medium to long-term horizon.
Everybody is saying one of the first insurance listing would be HDFC Life. Do you think Max would be the way to play it in the future after this particular deal being announced? Do you think that's also a reason why people would come out and buy into this name?
Yeah, because amongst the two, the larger player is HDFC Life, and definitely the way HDFC Life has done over the period of years, I think people would be betting on this company to get listed and come into and do the value unlocking. So on that basis also, there would be a lot of players coming into Max Finance. But overall, what we cover is Max Finance because it is again a demerged and amalgamated arm of Max India. So what we believe is this stock can give a good return with a medium to long term perspective. One should keep a hold, and we have a hold rating on the stock.
Right. How would you look at something like a DLF or maybe a Indiabull Real Estate? How are these names looking? Are things changing over there? So despite a 50-60% move, do you think these names would do well?
Again, Pankaj, we don't cover any of the stock in the real estate pack, but looking at the balance sheets, looking at the inventory levels, I think balance sheets are quite stretched, inventories are quite high. If we talk about the execution levels in the entire real estate pack, we don't find much of an execution percentage coming through if we talk about the tier 1 or the tier 2 companies of the real estate pack. So if we talk about the interest rates, although RBI has cut 150 basis point in last 1 year, but I think it is not completely passed on by the banks, which again benefits the consumer and which would again attract the consumers to take up some loans for buying the flats, and the inventories could come down. Even many of the real estate players have gone into the non-core segments and their investments, although DLF would be one play which they are coming out from the non-core businesses and focusing into the core businesses. But I think it will take time. Balance sheets has been stretched, inventories are tight. So we don't cover any of the stock, would not able to recommend. I think one should bet on the companies, southern-based companies with balance sheets are quite good. If you talk about the cash flows are also relatively better than the other companies.
Right. As far as some of these oil marketing companies are concerned, maybe they are not as buzzing as what they were earlier. But do you think that that's a space which can do well?
Yes, because if you talk about the history of oil marketing companies over a period of years, it has not performed. Although it has been performing since I think 3 to 4 years. But I think we can see another leg of good performance of OMC companies just because of marketing margins improving. Although crude oil prices going up, I think that will propel better marketing margins. GRM has been posted by most of the companies in this quarter, good GRMs, except IOC, which was around $3 odd, which was little on a disappointing end. But overall perspective, what we believe is OMCs should do good, at least beat the market returns over a period of year. And what we believe is if any kind of GRMs improving, I think these stocks will be beating the market benchmarks also.
Right. Siddharth, thank you so much for taking our time for us. Hope to see you again.